because we have someone with us who can actually analyze this thing, this issue of whether global liquidity will continue, whether yields globally will continue to remain soft, and what does all this mean for India. I have with me Maneesh Dangi, the CIO of fixed income at Aditya Birla AMC. Maneesh, thank you very much indeed for joining us. A great 2021 to you. Well, let me start off where Prashant left off. Do you know, in your note on the global economy, one of your premises is that we are going to continue to see a well-hydrated global growth thanks to easy liquidity, both monetary and fiscal. Would you have any reasons to doubt that, going by the doubts that Jeremy Grantham has placed on our head?
Look, one of the reasons equity markets were panicking in March was essentially they were being presumptive that, authorities would not come to rescue the system. And that doubt has been there throughout, and perhaps the reason why, it's taken time for the market to reinflate. So that doubt stays, Lata, but in a sense, we are in this world where monetary authorities and now, of course, even fiscal authorities are out there to backstop the system comprehensively. And so therefore, I have little doubt in terms of until the economy recovers, heals sharply from where it is right now and go to pre-COVID levels, I do not think that there'll be withdrawal of a lot of these stimulus, which is in play right now, both monetary and fiscal, and also policy stimulus, to a certain extent, in countries like ours. So I think this backstop would continue for a fairly long period of time. And I have no reason to doubt what Fed has been guiding, that, they would stay put with sort of zero rates for good 3 years now. Now, so trying to understand, given that I was listening to Prashant on the bubbliness of equity, it's important to note that, in US Treasuries is actually trading at 1% right now, whereas the break-even inflation for 5-10 years in US is about 2%. So US Treasuries today yield minus 1%. Now, contrast this with, earning yields, which is perhaps a good barometer of, what the real yield would be in equity. That's about 5% a year out. So to that extent, you could say the markets are expensive in equity, but they're not bubbly for sure.
Okay. Yeah, possible that when you compare it to bonds, but I guess Jeremy Grantham's premise is that central banks may have to increase yields, raise rates faster than the market now believes. Anyway, that's a separate discussion. Our central bank has started tapering. How can we ignore that? I mean, they've taken out or are going to take out 2 lakh crore on Friday with the variable rate reverse repo auction. How are you interpreting this? Are you only going to see the shorter term yields go up, or do you think we are going to see everyone pay a little more for money?
Look, our central bank has done an incredible job in terms of, they were ahead of most emerging markets, cut rates sharply, and induced huge amount of liquidity to the extent that, and then of course cut reverse repo rate, by an additional 40 basis points. So, and then let the liquidity go loose, and therefore the overnight rate started to trade 20, 30, 40 basis point below even reverse repo rate. So in a sense, today we have some context of recovery now. The October-December period has been fairly sharp. We've seen sharp recovery in economy. There's a large amount of money sloshing around in the system today in the country, and it makes sense to sort of unwind some of it. Now, having said that, this reverse repo auction of 14-day would simply take money out at reverse repo level, so perhaps 5 basis point wider from those. I think the basic objective is to get the system trade overnight at near reverse repo in next few months, 335. And then in terms of sequencing of withdrawal, it's about 6-8 months out that, perhaps reverse repo rate would be increased. So, it's fair to say it as a taper, but I think it's sort of a normalization of liquidity so that at least there is some sanctity, that at least even though the liquidity policy are loose, you still shouldn't have overnight money trading substantially below the reverse repo rate, and that is the purpose of this instrument right now.
Your guess is that reverse repo will be raised from the current 3.35 only in August or something?
My assessment is that it's actually more like September, October, when you would begin to see reverse repo getting repriced. Also, by then you'll have a good sense of the first quarter GDP reflation, and we think that there'll be a sharp recovery. And the only good news actually is, and perhaps we can discuss in detail there, that most likely the inflation has sort of peaked, and while for a good 1 year, central banks, economists, most sort of got this wrong on the lower side. In a sense, inflation did surprise on the higher. It's more likely than not that inflation would begin to surprise on the lower side over the next 6-8 months. But nonetheless, you will have to normalize reverse repo, and so I guess September, October is when we should see a 40 basis point jump in reverse repo.
You are going to be right for the next 2-3 months, because this December inflation is likely to come below 5%. We know that, and maybe even January would be very benign. There is a huge base effect going for these 2 months, but thereafter, look at the noise coming from Gadkari, for instance. He's trying to fight, almost shout down prices, rising prices of metals, cars, steel, cement, you name it. What makes you so confident? I mean, while, the RBI's own forecast is, I think, 4.6 to 5% for the first half of next year. That is, April to September 2021. It might well be the way around because of global metal prices and global commodity prices. Even softs, Maneesh Gupta, our commodities editor, is telling us, many of them, wheat, corn, sugar, all of them are at multi-year highs.
I mean, yeah, they of course, commodities have inflated. But, let's understand the CPI composition, Lata. In the end, all the stuff that you talked about is only 18-19% of CPI. Near half of CPI is food. And then about 30% is some sort of services. And on both, actually, so a predominant part of CPI should see a large amount of disinflation. I mean, in food, you sort of have a clear case of a large amount of term of trade adjustment playing out in favor of a farm economy. I mean, last 2 years, you've had good 20% rise in food prices, whereas the core has gone up by only 8%. So there is a 12%, 13% TOT adjustment in favor of food. We are a food surplus economy, Lata, and that, what was happening since 2014 is because of a rapid rise in the total food surplus that we've had, the food prices never inflated. Also, last 2 years, the CPI weighted MSP is close to 3%. So in a sense, the other reason why food used to inflate was because of administrative reasons. So because of the surplus food conditions, MSP rising tepidly, my sense is that, and the TOT adjustment which has sort of taken place over the last 2 years, my sense is that, markets are going to be surprised sharply on the lower side on food inflation, which is about half of CPI. Also on the service CPI.
No, I'll take your point on that, because, the market is kind of, in terms of market economists, are kind of split down the middle in terms of inflation expectations. And of course, we have only the RBI's guide post, and that is more aligned with what you are saying, between 4.6 and 5%. But let me come to what you are therefore advising investors. Therefore, do we not go to bond funds? You are not expecting capital returns at all for bond investors. What is the advice?
No, see, broad advice is that it's very unlikely that rates will spike up dramatically. Episodes like 2004 or 2010 won't happen, is a broad advice. Also, markets have been extremely circumspect, and which is why the term spreads are very, very elevated, historic levels of term spreads that we see in India. The 210 spreads are at near 200 basis point, For this kind of economy, these spreads shouldn't be there, but because they've been guided higher and for a variety of reasons that we can discuss, term spreads are high, and therefore they're already baking in many rate hikes and tight liquidity at some point in time. So therefore, the advice for the investor is, to do not run ALM. If you are a 3-year money today, you can buy a 3-year corporate bond, a good AAA corporate bond at 5.5, 560. You have a 10-year money, you can buy 670. Now, just contrast this. I mean, it's very likely that your next 10-year inflation in India would be, you could debate between 4 or 5 somewhere, but you still have 170 basis point of real rate in corporate, in AAA, PSUs, and about 100 basis point in government bond. Contrast this with, what's happening in US, where it's more likely to be minus 1%. Same as with bonds. So in a sense, India is a place where even fixed income would perhaps deliver reasonable positive returns. And there are very few places such as these. So I think, general advice to investor is that, do not run ALM. Try and invest in longer term through 2, 3, 5, 10 year, depending upon investing horizon that you have in corresponding maturity bonds.
Okay. All right, we are out of time, Maneesh, but it was extremely enlightening speaking with you. Thank you very much indeed for joining us. Okay, so yes, if you are expecting inflation to remain at 4 or 5%, then as Maneesh says, it makes sense if you're investing in even 10-year G-Secs and definitely in longer-term corporate paper. Well, I'm sorry I've snatched time away from the Trading Hour team. Reema, Prashant, thank you very much.